Welcome to this Forex Preview here at XM.com. I'm Cristina Marujos, and joining me today is investment analyst Cristina Parthenidu. We'll be looking at GDP figures out of the United Kingdom for Q3 that are going to be released on Thursday, just a week after the Bank of England backed down rate hike expectations and, of course, lowered its growth projections for the next 2 years. Therefore, what do you think we're likely to see in the numbers?
Hi, Christina. Indeed, the Bank of England didn't raise interest rates during last week's policy meeting, as many investors thought that this would be the case, arguing instead that although rate expectations are in the right direction, it's not the right time to raise borrowing costs at a time when supply chain disruptions, labor shortages keep weighing on business activities and therefore keep inflation elevated. While there are also some worrying signals about consumption at the moment, consumption has been decelerating over the past 5 months, according to retail sales data, and that needs to be closely watched since consumption accounts for a large share of economic growth, not only in the UK, but also in the rest of the world. So on the one hand, the persisting inflationary pressures call for a tighter monetary policy, and that's why we see some policymakers leaning to the hawkish side. But on the other hand, economic growth is still facing downside risks from post-pandemic effects. Now about this week's data, GDP growth is expected to show a sharp slowdown. The annual expansion is expected to come in at 6.8%, which is well below the impressive boom of 23.6% we got in the second quarter. The quarterly growth compared to the previous quarter is also expected to decelerate significantly to 1.5% from 5.5% previously. Of course, such an outcome would still be robust, and traders may not get very upset, putting instead the blame on the fading base effect since the 2020 low numbers move out of the calculation. So reasonably, the comparison could be less dramatic, but still we can't ignore any weakness either, given the uncertainty around inflation, as well as the worsening trade relations between the EU and the UK, which have been lately threatening a violation of the withdrawal agreement, which was signed last December. So unlike other economies, the UK is also facing post-Brexit political risks, and that suggests the Bank of England has probably made the right choice of adopting a wait-and-see mode last week.
Now, having a look at the pound as well, it's been taking its cues lately from the signals by the Bank of England. Do you think the GDP report could move the currency in a significant way?
Well, not really. What's important for the pound at the moment is when the Bank of England will start raising its interest rates. As I mentioned before, the Bank of England didn't entirely exclude the case of higher interest rates, but its intention was mainly to calm the aggressive pricing of tightening, and to some extent it was successful. Currently, interest rates futures provide a probability of around 52% for a rate hike in December, and also price 3 more till the end of 2022, but the odds are lower compared to the week before the BOE meeting. That suggests that investors are still positive about the rate hike scenario, but they just are not sure whether that will happen at the end of this year or some point in 2022. Apparently, missing GDP data could raise some caution about the path of interest rates, but investors have already got some bitter taste from the weak monthly GDP growth figures in August and July. So a pullback in Wednesday's data may not be a big surprise, and therefore could barely affect rate expectations and the pound, of course. Nevertheless, if we see some negative moves in pound dollar, for example, I would keep a close eye on the 1.3411 support level for any aggressive declines once that base gets clearly violated. Now, what if the data are priced to the upside? Well, I think that should be a very significant deviation in order to play well into rate hike expectations and therefore boost pound dollar above the 1.36 resistance. But as in the case of the Fed, the Bank of England has already directed investors, saying that progress in the labor market and particularly growth in wages will be the main criteria for changing policy. So the jobs data next week will probably be a bigger source of volatility for the pound than this week's GDP growth data, while trade developments between the UK and the EU, I think, could also move the pound before the next policy meeting in December.
Cristina, thank you for joining me today. This was a Forex Preview on UK GDP data for Q3 out on Thursday. Thanks for watching here at XM.com.